In the wake of the naked short-selling era and the emergence of synthetic shares, a new player has entered the financial scene: synthetic risk transfers orchestrated by banks. Once again, the financial landscape is being reshaped as us banks seek ways to mitigate risk amidst tightening regulations and capital requirements.
Hello, everyone.
Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert: this is not a financial advice video. As highlighted in a recent expose by the Wall Street Journal, major US banks such as JP Morgan Chase, Morgan Stanley, and US Bank are pioneering a strategy to offload risk through synthetic risk transfers. These transfers serve as a mechanism to comply with regulatory changes while minimizing exposure to risky assets in their portfolios. So, what exactly are synthetic risk transfers? Essentially, they involve the creation and sale of complex debt instruments to entities like hedge funds and private equity funds. These instruments enable banks to reduce their regulatory capital requirements, facilitating smoother lending processes. But here's where things start to get intriguing. While synthetic risk transfers come at a cost to banks, they prove to be less burdensome compared to bearing full capital charges on underlying assets. For investors, however, they present an enticing opportunity, with potential returns averaging around 15%. Interestingly, US banks had been relatively hesitant to delve into this market until recently, opting to observe regulatory developments and Federal Reserve actions. With the looming specter of increased capital requirements and regulatory scrutiny, banks have found synthetic risk transfers to be an appealing strategy for risk management. Now, let's delve into the mechanics of synthetic risk transfers. Investors typically purchase credit-linked notes issued by banks, receiving interest payments in return. These notes are tied to the performance of underlying assets, with investors assuming the risk of default on up to 10% of pooled loans. The allure for banks lies in the upfront cash influx generated by selling these notes, outweighing the minimal interest payments they must make. In essence, banks transfer a portion of their risk to investors, safeguarding their own financial stability. But what about the potential downside for investors? While they stand to earn interest, they also face the possibility of absorbing losses in the event of loan defaults. However, by diversifying their investments across multiple notes and anticipating default rates, investors can mitigate this risk to a certain extent. To illustrate, consider a scenario where a bank sells $1 million worth of credit-linked notes. Despite the risk of defaults, the upfront cash infusion provides a buffer against potential losses. In essence, investors must weigh the nominal interest payments against the potential magnitude of losses, ultimately balancing risk and reward. In conclusion, synthetic risk transfers represent a novel approach for banks to navigate evolving regulatory landscapes while optimizing their capital positions. For investors, these instruments offer an opportunity to earn attractive returns, albeit with inherent risks. As financial markets continue to evolve, synthetic risk transfers are likely to remain a prominent feature of the banking sector's risk management toolkit. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.